I'm Adam Myers. I lead the distribution team at Pengana. Thank you for joining us for this webinar update with Fred Pollock, the portfolio manager of PE1 and the chief investment officer at GCM Grosvenor, and Corey Lepretti, who heads up portfolio construction and is really the one who's across all the detail. The format of today's webinar will be a short presentation of around 15 minutes, which will leave plenty of time for Q&A at the end. So any questions that you have about the fund, the economic environment, private equity in general, or specific fund exposures, please enter them into the Q&A box, which can be accessed from the icon of your screen, and I'm sure we can have a really interesting conversation at the end. Fred, over to you.
For the introduction. So, as Adam mentioned, I'll spend the first half of the time going through and talking about the environment and the markets and what we're seeing and how it's affecting private equity. And then I'll turn it over to Corey, who's going to go through a little bit of detail on the PE1 trust and some of its allocations and how it's being affected. So starting on this slide, quantitative tightening and terminal rates. So the big movements in the market since Q4 of last year, so basically 12 months ago, people realized inflation wasn't transitory, and they started repricing interest rates and the cost of money. And you've seen that across the board. So CPI has ticked up during this entire period, and then the base rate, meaning treasuries or SOFR, in the case of the international standard for the base rate, is about 4% today. If you went back a year ago, it was 0.5% or less in all cases. And so you've had a substantial increase in the cost of money, even the safest and shortest duration. And then if you worked your way across the capital structure, you've seen that go into the cost of debt for private equity businesses, and you've seen it price into the cost of equity for private equity businesses. And we'll spend a lot of time talking about that today. If we could turn to the next slide. What this has really resulted in, if you increase interest rates, obviously money costs more and the cash flows in the future are worth less. And so you've seen a drawdown kind of across the board in markets. First, you see on the left hand of the slide in the equity markets and the public equity markets, particularly where there's large tech companies where dominate the indices, in the case of the NASDAQ or the S&P 500 in the US, those cash flows are very far out. And a lot of the value is in the growth of those cash flows over time. They're most acutely affected when you raise the cost of money or raise interest rates. And so you've seen a significant decline in the values of those indices. I think if you look today, they're down 20% plus kind of across the board, 30% plus in the case of the tech-heavy NASDAQ. If you looked across the broader indices, what you'll see, there's other types of companies that are much more substantially impacted. So, there are many percentages of companies, if you look on the right-hand side, which are down more than 50% from their 52-week high. So it's not even that the indices have behaved poorly over the course of this transition. There are particular companies that have been affected in a much more significant way, particularly growth-oriented companies, biotech companies, technology companies, et cetera. The things that have held up the best actually are cyclical companies, banks, and some other sectors that are least affected by the rate movements that we've experienced so far. If we go to the next slide, what's the big conclusion for private equity? You haven't seen as big an impact for private equity. So typically what we observe through these types of cycles is that private equity experiences losses that are less than half of what we observe in the public markets. There's a couple different reasons for that. One of them is that there's an internal rate of return in a private equity holding, which is pretty high, mid-teens or better typically in a year. And so even if you go through a year where the markets go down 20 or 30%, there's some gains in the underlying economics of the positions and the cash flows that help offset that. The other thing that you'll have in private equity, it tends to be in those sectors that are more cash flowing, lower multiple, lower growth than the average public market security. And so they're just less affected by an interest rate increase in a lot of cases than you would see in those indices. And then really the action happens in terms of the capital structure and the debt on the individual company. So if you looked across these two broad indices that we use for North American buyout and North American growth, you'll see, we call it the Burgess indices. You don't really need to know much about that other than it's probably the broadest based indices of private equity companies or private companies that you'll find out there. You'll see that it started to tick down and it's been trading down. You see the dates here stop at June 30th. It would continue to decline, in the third quarter and then much of the fourth quarter as well. I think you should expect a continued decline during this period, but less pronounced than what you would observe in the public markets. You will see on the right that the growth indices is more substantially impacted than the private equity indices or the broad buyout indices. It's exactly what you would expect. It's the same phenomenon that you're seeing in the public markets. If we go to the next slide, how do we really see the impacts in a private equity business? So if you think about what exists in PE1, for the most part, the companies are high cash flowing, lower multiple, more stable businesses, right, that are least affected essentially by the rising cost of money, but they are affected nonetheless. And the place that you're really seeing it is in their capital structures on the debt side. So borrowing costs have increased pretty substantially. So if you increase the base rate by 4% and you increase the spread by another sort of percent or so, you're increasing the cost of debt by essentially a doubling, which you would see on the right graph here in terms of borrowing costs in a high yield market. So, you see roughly the same effect, 4.5% debt going to sort of 9% debt or a little over 9% debt in terms of the cost. Some of that was spread widening, as you see in the middle of this chart, but most of it actually was the base rate, which would flow through. And pretty simply speaking, if you think economically about a very solid cash flowing private equity business, if you take its cash flows and you have to use more of them to satisfy the debt, there's less available for equity holders, and then you discount those remaining equity cash flows at a higher rate, you see a decline in the multiples, which is what we've seen kind of across the board during this year. And so, one of the things you would observe in the PE1 trust, if you look through to the 375 or so underlying companies in the portfolio today, multiples have come down. It doesn't mean necessarily the values have come down because you had cash flows that were growing during the same period of time. In some cases, valuations also came down. And then you'd see an offsetting effect also in terms of the Aussie currency, where most of these assets are held in US dollars or euros. And that's been beneficial in terms of the currency in the overall NAV of the portfolio. If we go to the next slide, one of the things that I think is going to become interesting is whether you get a distress cycle. So most of the debt that's issued in the private equity world is floating rate, meaning that it's got a base rate like SOFR or LIBOR or treasuries, which has increased from 0 to 4%. And the spreads have increased by about 100 basis points. You would think that that would cause fairly significant distress for poor companies or over-leveraged companies. You haven't really seen an enormous amount of that yet because most of the debt that was issued over the last 5 or 10 years was called covenant light, meaning it doesn't have any covenants other than you need to pay the interest. And people are doing a pretty good job during this cycle so far of finding ways of continuing to pay interest, even for companies that are a little bit stressed or over-levered. I would tell you, we are tracking this as a point of opportunity. And so I'll talk about the opportunity set in a little bit, but I think in the course of 2023 and 2024, you should expect a pickup in distress as borrowers finally find they're incapable of making the interest payments, and you actually have kind of explicit defaults and bankruptcies in the private equity space. But it's too early so far to actually see that pickup. I would tell you also that we've called this in the past and gotten it wrong. So people have been calling for a distress cycle for a very long time in the broader economy, both public and private companies. And it's probably overdue, but there hasn't been one in a long time. And people haven't seen the amount of distress that they were expecting in prior cycles. On the next slide, maybe I'll talk a little bit about how does PE behave, and then I'll use this as a good chance to talk about the opportunity set as we see it. So, as you'll observe in this slide, private equity, if you're in the right type of private equity, meaning you're with upper quartile or top quartile managers, the top 25%, across the board, you generally speaking outperform, but more importantly, you perform well even after these market dislocations. And there's a lot of reasons for that. I think one of the primary reasons we would look to is that these managers are typically seasoned. They've been through a full cycle. They know how to invest through these periods of time. They do a good job also of managing their existing portfolio companies. They don't over-lever them. They tend to be focused more on generating increasing operating cash flows instead of financial engineering, which obviously would be very vulnerable during this cycle. If you were strictly a financial engineer, this would be a poor environment for you. Also, they're just cycle tested in terms of managing through the types of businesses that they are involved in over this period of time. And so, we continue to see decent performance in the underlying companies, been pleased with the way that managers have been handling it across the board. And we would expect that to continue as long as we've done a good job of kind of curating a set of relationships that exist in this upper quartile. If you go to the next slide, the market opportunity. So, where are we seeing the biggest opportunities? 3 areas I would highlight. The first I mentioned a little bit earlier is distress. So I do believe that there will be, for the first time in maybe a decade or more, a real distress for control opportunity. And so you can sometimes create private equity enterprises and enter them through the bankruptcy process. You don't have to buy something in an auction. You don't have to buy it from a strategic or a corporate. You don't have to buy it from another private equity fund. You can also create and enter these businesses through an orderly bankruptcy process after they've gone through it. There's a couple of tricks to that. One, we have no interest in investing in turnarounds. So we have no interest in investing in companies where they're broken and they've gone into bankruptcy because they're broken. What we're interested in are companies that are very good, have high cash flows, are good operating businesses, have good secular trends associated with them, but someone over-levered them. And so it's a good company with a bad balance sheet. And that's one of the areas we'll attack. The other trick to it, you need to invest in what's called a fulcrum security. So if you want to get equitized in a bankruptcy process, you need to make sure you're in the right part of the capital structure, which is likely to end up with control and ownership of that business on an extended basis. And we have a number of partners who do this. They haven't had much to do for a decade, but we're very excited about the potential opportunity kind of on a go-forward basis. The other thing I would point out, secondaries are becoming extremely attractive on an opportunistic basis. So the ability to go out and purchase private equity interest, existing both fund interest as well as single asset or multi-asset interest, has really not been more compelling in probably 5 to 7 years. And so we're excited about those opportunities just to create private equity again at kind of a meaningful discount. And then finally, the credit market itself, meaning the private credit market participating in the parts of the capital structure which now are pricing at very attractive risk-adjusted returns. In the past, we shied away from that. You'll notice in the PE1 trust that we always had an allocation to alternative credit or private credit. We didn't utilize it for the last couple of years. We're starting to utilize it now because those types of securities are more interesting on a risk-adjusted basis than they've been in the past, now that you've started to experience a repricing, experience a cycle. So, my broader market comments would be, so far the portfolio is doing well. It's an environment that's balanced in the sense that it has hurt multiples, but we've continued to see cash flows growing on the underlying businesses to help offset that. The currency has certainly helped the NAV evolution during this period of time. And the opportunity set has gotten more compelling. It's just a natural corollary. If prices and multiples go down, the forward expected returns from those holdings and new holdings that we could purchase for the trust continue to improve. And given the trust is sitting on a little over 20% in cash, we're excited by that proposition. There's flexibility and there's an opportunity to take advantage of that type of market environment. So with that, and obviously be here for questions, I'm going to turn it over to Corey to talk through a little bit more detail of the PE1 trust and some of the portfolio dynamics. Corey?
So slide 11 provides a high-level overview of PE1's current portfolio allocations. Now, as you're likely aware, we launched PE1 3.5 years ago, and the fund is now fully committed. Its exposure to some 60 funds, over 375 companies, with vintage years dating back to 2003. We've committed more than 100% of the capital we raised from investors, and we've already seen material realization activity within the portfolio. PE1 has already received over $60 million in distributions from its investments. Drilling down a bit, we've invested in 15 primary private equity funds, and portfolio currently has exposure to more than 90 co-investments in directs and 11 secondary transactions. The portfolio is already showing the broad diversification we were seeking for the long-term portfolio when we launched PE1. If you look at the current portfolio mix, you can see that the equity co-investment in direct sleeve is larger than the equity fund sleeve. While part of this is by design, as we always expect this to be the largest component of the portfolio, there are a couple of primary reasons for this. One, the first and some of the largest investments PE1 made were into partially seeded portfolios of co-investments. And two, the investments in this sleeve have had very strong performance to date, which I'll get into in a minute. All that said, the equity fund sleeve is tracking along nicely, with the primary funds ramping up activity and now having called more than half of what we've committed, even when you take into account new commitments we made this year. And as Fred mentioned, given where we see the opportunity in the private credit space, we did begin executing on our private credit strategy for PE1 earlier this year. This will be the first time, if you've seen this slide before, where you're showing an allocation there. Here it's at 2% now. We will scale that up, assuming the opportunity set remains rich, to somewhere between 5 and 10%. That was always intended to be in the long-term portfolio to provide some portfolio ballast and reduce volatility. With our current allocation, we're targeting 30 to 40 investments. We've executed 7 to date. and they're collectively generating a pretty attractive 11.5% estimated current yield. And also, as Fred mentioned, we are pretty excited by the fact that we have 22% of the portfolio in cash, given that historically recessionary and post-recessionary periods have generated some of the most attractive vintage years in PE. Turning now to slide 12, I'll use this to talk about the different sleeves and provide an update on performance and some of our recent activity. So just as a reminder, there are two different tools we currently use to execute co-investments in direct for the PE1 portfolio: our multi-asset class or MAC funds and our co-investment opportunities funds. PE1 has 187 million in commitments to our multi-asset class strategy, which is designed to mine the most compelling risk-adjusted return opportunities from anywhere on our platform. It's entirely opportunistic, and that really allows us to be quite tactical in markets like today that are volatile or uncertain. Our first multi-asset class tool, MAC2, is fully invested, 62 investments currently in the portfolio, nearly all of which are co-investments, and it's shown really strong inception to date performance, generated a 1.8 times net multiple and a 24% net IRR to PE1 through the end of October. While we would expect a very modest decline in performance once 30 September valuations are finalized, as the declines in public market comps work their way into PE1's mark, the declines were offset by a number of increases as well. I think most importantly, we do believe that the fundamentals of the businesses in the MAC portfolio remain strong and believe that MAC2 is on pace to exceed its performance targets. It is also entering the harvesting mode, and we expect there to be a fairly significant increase in realization activity in 2023, the number of companies indicating that they will start processes next year. MAC3 has been quite active since its launch a little over a year ago, deploying about 40% of its commitments. That fund has invested over 820 million in 18 investments. And we believe we have been very prudent and cautious in deploying capital so far, seeking to invest in things like preferred securities, where we have downside protection through structuring. The existing portfolio is slightly up since inception. We have a number of assets in the portfolio accruing value, like SpaceX and Uber Freight. We also had an early realization at a profit when Deliverr, a third-party logistics platform serving e-commerce merchants, was acquired by Shopify less than a year after we invested, generated a pretty attractive IRR to our fund. I'm going to highlight one of our deals in the MAC funds, Lineage Logistics, because it is currently the second largest position in the PE1 portfolio, and they recently raised capital at a premium to the last round, which will result in a nice markup of our investment once 30 September valuations are finalized. Lineage, global warehousing and logistics companies specializing in cold storage. So food comes off the farm or out of a manufacturing facility, goes to large refrigerated warehouses called cold storage before ultimately going to retailers or directly to consumers. Cash flows are very infrastructure-like, so there's limited to no volatility. In fact, they grow with inflation, so it is a very stable business that is especially attractive right now given the broader market uncertainty. Lineage has been rolling up the cold storage sector, realizing huge economies of scale, and we expect the company to look to go public next year, assuming the IPO markets are open. Our other tool for co-investments, our co-investment opportunities fund, which seeks to invest alongside high-quality middle-market buyout managers in companies that have established revenue models, and preferably in defensive sectors, things like healthcare and consumer staples. Portfolio currently includes 19 investments. It's well diversified by industry, geography, vintage, and sponsor. The portfolio has had 4 realizations and 3 partial realizations to date, and those realizations have generated a 2.3 times return to the fund. GCF2 has also returned more than 55% of investors' capital, and we expect one of the partially realized investments to become fully realized by the end of the year. The remaining investments in the portfolio are performing quite well, with no investment marked below cost, and all of that is helping to drive a very healthy 37% investment to date IRR and a nearly 2x net return to PE1. While we do anticipate that a number of investments will be marked down a bit once 30 September marks are finalized, due again in large part to a decline in public market comps, 8 investments are currently expected to be marked above at 2 times once those marks are finalized, and we expect that the aggregate return to the fund will actually go up a bit. One of the investments that's driving this is an investment in a company called Inifis. Inifis, it's a US-based leading producer of phosphate and non-phosphate ingredients used in consumer goods. It adds taste and texture to foods, it's used in vitamins, and it's also used in some industrial products and processes. So over the last 12 months, the company saw its EBITDA increase over 200% versus the prior year. And that was primarily driven by very modest price increases each quarter and volume growth due to strong consumer demand. That investment is expected to be marked up significantly as of 30 September. We believe there's a good chance the investment will be realized at some point in 2023. The equity fund sleeve is comprised of our secondaries and our primaries. For the secondaries portion of the portfolio, we leverage our broad relationships and investments in over 950 private equity funds to really help drive our sourcing and our market intelligence. And I think as many may recall, in 2019, we were a little slow there. Since the end of 2020, we've been really active, committing 124 million to 6 secondary transactions. 66 million of that was committed to our secondary opportunities fund, which is basically just an implementation tool that provides investors with a single point of entry to a portfolio of secondaries. Fund has already closed on 15 transactions, and that includes 8 GP-led secondaries and 1 traditional LP secondary transaction year to date in 2022. The opportunity set has really begun to shift, and Fred referred to this before, with an increasing number of LP deals under diligence. In fact, we currently have 4 of those deals under diligence that could close by year end, with an average estimated discounted close of 15 to 20%. We expect more of those types of transactions at attractive discounts should this economic downturn persist, as many institutional investors will become over-allocated to PE due to declines in their public market books, or will otherwise require liquidity, which could make them forced sellers and create a really nice opportunity set for PE1. We have also committed 58 million to 5 standalone secondaries. They provided PE1 with significant vintage year diversification, funds ranging from 2003 to 2019, and they have early net returns of around 100% from an IRR perspective and a 2x multiple. Most of that is being driven from the largest standalone secondary transaction, Project Rambler. That was a $46 million commitment, big portfolio, 35 funds, 100 different underlying companies. That transaction ultimately had a discounted close of over 43%, and it continues to outperform our underwriting expectations. It's generated more than a 2x net return to PE1 to date, and it's already distributed more than 100% of the capital PE1 invested in the deal in just over a year. In our primary sleeve, we made commitments of 91 million, 15 primary private equity funds, which includes 11 difficult to access middle market buyout funds, 2 growth funds, and 2 special situations funds from 5 different vintage years. It's still pretty early there. Primaries we have committed to still having around 50% of their capital to deploy in a market that we believe should create a pretty rich opportunity set. That said, all said, we are pleased with the early returns. The funds are generating a 27% net IRR and a 1.3x net multiple to PE1 as of the end of October. Finally, I want to touch briefly on the tactical sleeve. As you may recall, the tactical sleeve was created to enable us to enhance diversification within the portfolio and thereby lower downside risk. So as we would be able to target specific sub-strategies based on both the current and projected portfolio composition for PE1. We have looked at several deals for the sleeve and actually had the first deal slotted for the sleeve of the portfolio last spring. It was an interesting transaction with a large LP portfolio deal, and we hadn't seen a ton of those recently. It involved more than 10 funds from 9 different vintage years. At the time we priced the deal, the discounted close was expected to be in excess of 20%. However, due to the market volatility in late Q1 and into Q2, which really impacted the public positions in the portfolio, the discount shrunk and we sought to reprice the deal and ultimately couldn't agree with the seller. Disappointing result for us, but we thought the most important thing was for us to be disciplined with our deployment. Roll things forward a few months, we now have another secondary purchase of an LP portfolio, 5 funds, 4 of which are highly restrictive on buyers, and is expected to close by the end of the year and sign in a couple of weeks. That portfolio will be purchased at an estimated discounted close of around 20%. It's well diversified, over 60 companies, and the top position represents less than 8% of NAV. Slide 13 lays out the 10 largest positions in the portfolio, the largest of which is a company called Gainwell Technologies. Gainwell provides technology solutions. They're important to the administration and operations of a health program throughout the U.S. Their technology facilitates things like claims processing, provider management, that sort of stuff. Since our investment in October 2020, both revenue and EBITDA have increased substantially. And as a result, that investment is going to be marked up to a 2.5 to 3x multiple as of 30 September, which we think is particularly notable since the investment is still quite young. Now, it is important to note that the initial investment obviously wasn't this large. The position has increased to 5% of the PE1 portfolio due to the fact that it has performed quite well. And it is also in one of our primary funds, Veritas 7, as well as in MAC2 and GCF2. Performance is also what has driven the size of investments like Lineage, which I mentioned before, and then SpaceX to the top of our list. So we're feeling pretty good about where we are. And again, most of these positions are pretty small relative to the overall book, which was by design when we created this program. And then last thing I'll touch on is performance. All of the activity has led to very strong cumulative returns since inception. Overall, we have NAV up 25% over the last year, and we've generated annualized returns of 14% since inception as of 31 October. We do think the performance to date is made even more impressive by the fact that we're still ramping in the portfolio over the last couple of years, which means that the actual PE returns are well in excess of the returns reflected here. Why don't I stop there and open it up to questions?
Great. Thank you very much to both of you. That was very comprehensive, and we have already received a number of questions, which I think are quite interesting. First question, Fred, probably for you. You aim to invest with top quartile cycle-tested managers. Do you go back and check if your managers are performing in line with expectations and if their experience actually pays off? And the second part of that question is, if the answer is yes, what do you find?
The answer is definitely yes. So we try and check two things. We check the things we do and the things we don't do, meaning we have a fairly exhaustive peer universe of all the funds, and we track all their performance. And then we also look very carefully at the decisions we make and how people perform during good times and bad times, and underwrite and understand kind of the nature of each of the investments they're making. Probably the hardest decision we have to make in our system is it's not even to punish people or take capital away from or not renew investments with people who are doing poorly. The hardest decision actually is deciding when not to give capital again to someone who's performing well, but we think something has changed that will make it in the future perform less well. And, we try and do that as well. And we're not perfect, but if we sort of bat 55, 60% in terms of these very close calls, we'll have very good performance overall. And that's sort of what we aim to do.
So just a follow-up, how long into the current downturn will we need to get before we can confidently say that our investments have been resilient?
I'll take that one, I guess. I'm not sure I know an answer to that. So I don't have a crystal ball, and I can't tell you what the economy is going to do in the future. What I will tell you is the portfolio has held up very well so far. Like, we're very pleased actually with how the underlying performance has worked. And I don't mean that in a sense of just valuations, but the actual performance of the individual companies and the performance of the sponsors with respect to those companies has actually been very, very good. And the companies themselves, there isn't a substantial amount of distress or anything else that we're seeing in the portfolios or any of the capital structures. So I do think the debt part of the capital structure, you've been through the repricing. I think it's over. Like, I don't think you're going to see a substantial increase in the base rates anymore. I don't think you're going to see a substantial increase in the spreads. So that part of the kind of repricing phenomenon is already there. The part of the cycle that we haven't been through is what are the real economic consequences of that in terms of broader demand, cyclicality, or recession, or whether that's shallow, whether that's deep. That'll be the thing that has to work its way through kind of the overall system. And I would expect you'll see that kind of 2023. You could even see it spill over into 2024. But you'll see some of that. The passage of time will result in the companies being able to produce some value to offset any degradation you see from that. But it'll really depend on how severe it is. And I don't think anybody could tell. I don't think anybody on this call certainly could do it, but I don't think anybody in the world could tell you exactly what's going to happen, with the economy next year and the year after. But we're prepared for it, right? This is kind of the key point.
Great. The questions are coming in thick and fast. I'm trying to keep track. But Corey, perhaps the next one for you is that we have always stated that we don't invest in venture capital, but SpaceX is regarded as VC by a number of funds. Can we please explain clearly what we invest in, what we don't, and how those differentiations are really classified?
Sure, and we definitely do not invest for this portfolio in venture capital. We tend to stick to buyout, some special situations, and some growth equity. So when we invested in SpaceX, the company had been around for 15 years. It had a real business model. It had real revenues coming in. We're looking to companies that are not at the concept stage, but are sort of later in the life and are really moving to that next stage. So we did invest in SpaceX at a much nicer valuation than where it currently is held. So we've had a nice write up in that asset. But we are looking for companies that are moving through into commercialization and so are much further along in the value creation train of their lives.
Great, thank you. Next question, potentially for Fred again. We made a comment in the presentation that we're expecting realizations to begin in earnest in 2023. Are you assuming that the environment will be more favorable then, does that reflect simply a maturity of the business, or should investors actually be expecting hold back unless the environment does become more favorable?
I think it's a good question. So typically realizations slow down when the market declines. It's just a natural phenomenon, meaning people are looking to exit into the strongest possible market that they can. So you've seen that slow down, but there are any number of businesses in the portfolio that are performing really, really well. They've executed to plan. They've held up reasonably well. Like a classic example is Lineage Logistics. Lineage Logistics will go public. It's going to go public whether, it's kind of later this year, next year, it's going public. It'll go public at a very sound multiple and probably an uplift to the valuation we have it held at. That's going to happen regardless. It happens to be in a sector that's very resilient, and there's still a high appetite, even in the public markets, for that. There's a lot of other companies that trade sale and other strategic opportunities are available for sale. So I think you'll continue to see those realizations for sure. It's just based on the natural maturation of the portfolio based on when we built it up. It'll just be a little slower than you would have otherwise been. If I said 2021 was probably the frothiest market I've seen in a long time, 2023 could be one of the least frothy markets we see. So I think you will see a slowdown in terms of the realizations, and then things should normalize at some point after that.
Great, thank you. We have received a few different questions about the discount to NAV. So I think I'll let Fred and Corey off the hook and I'll take this one. The first point that I would like to make is that through its life, PE1 has largely traded at or around NAV. Sometimes it's slightly ahead, sometimes it's slightly below. We did have a period when the units were trading at a huge premium because there was way too much demand, but that really undermines the potential returns for new investors. So we undertook a small capital raising, we issued more units, and that helped us to restore the supply-demand balance. Our preference is always for the vehicle to trade as close to NAV as possible. More recently, we have been trading at a bit of a discount, which obviously is great for new investors, but less great for investors who are exiting their positions or who are sort of very aware of the ongoing mark-to-markets. And in market downturns, we often see a reduction in liquidity, particularly in smaller capitalized vehicles, and we think that PE1 has been affected by this. But a couple of questions have sort of asked, what are we doing? We obviously can't control the ASX price, so what can we do? From time to time, Pengana can, and we do buy units on the ASX. We don't buy them in the trust and cancel them as other issuers do, because this, while it offers a short-term support mechanism, in the longer term, it actually adds to the problem by shrinking the vehicle. Larger vehicles typically trade closer to NAV. So I think that's key. We back our investments. We put our collective money where our mouth is by buying units in Pengana as opposed to inside the vehicle. And we also work very hard to promote the vehicle, to generate new interest. We do our best to produce clear and accessible communication. But we obviously want to keep new interest coming, to refresh the register. And in the last few weeks, both Corey and Fred have been in Australia talking to investors, both new and prospective, and generating interest, knowledge, and awareness about the fund. And we think that is key. The other thing that we think is key is that the trust continues to do what it's supposed to, and that is that it continues to perform in line with investor expectations. And to date, that has certainly been the case, as Corey has illustrated. The last point that I do want to make, because when I saw the first question come through, I quickly looked up last night's close, which was $1.60. I think our last published NAV is $1.71, so that's about 6 or 7%. But remember also the Aussie dollar has strengthened over the last month by a few cents. So the discount at the moment really isn't massive. We do think that a lot of the things that we are doing are making an impact. Very long answer and nobody dialed into here from me. So I'm going to go on to the next question, which is on secondaries. Somebody's asking the difference between GP and LP-led secondaries. Maybe, Corey, over to you.
Sure, I'm happy to take that. So GP-led secondary market has existed for a long time, but it's really had a massive proliferation over the last couple of years. Historically, before the recent period, GP-led secondaries, GPs would be sort of late in the life of their primary funds, and they would sell a few underperforming assets into a vehicle really to get them off the books and be able to wind down their funds. But what started to transpire in the last couple of years is that a number of GPs sort of moved the market in a different direction, and they didn't want to give up on an asset that was really strongly performing, but that because of the realities of running a fund and what the liquidation period and the expectations of their investor were, they would have to go ahead and sell those investments to a new sponsor. So what they started to do is try to cherry pick the best assets that are sort of later in their life, and rather than allow another sponsor to continue to the value creation that they had started and realize a greater return from those investments, they've been selling them to a vehicle, so crystallizing a return for the funds that they are in, and then selling it to the market. Market dictates sort of what that pricing will be. So it's rational from that perspective. One thing I will say, it is very important, though, is to make sure if you are investing in these, one, the fundamental business has to be really strong, and you underwrite that business as part of your process and do full diligence on the company. But two, you really have to make sure you have a strong alignment of interest with the GP, because if not, the GP could effectively be selling the asset to crystallize fees for themselves, their performance fees, and ultimately then creating an income stream off of the new asset. So we try to make sure that both the sponsor or manager is rolling all or nearly all of their performance fees that they would have crystallized off the original investment. We want to see management of the company rolling a significant portion, if not all of their capital as well. And we want to see a meaningful commitment from another vehicle that the manager is running, usually a large commitment from their next fund. So it's important that you look at all of those things. One thing I will say is that GP-led secondaries look a lot like co-investments. The one thing that is different, and I suppose a benefit of a GP-led secondary to some extent, is that unlike with a co-investment or a direct investment where a sponsor has to come in and through its diligence it's identified the value creation levers and the like, they still have to insert their own new management team and start to actually dig in on the companies to a larger extent. With a GP-led secondary, they already have their value creation playbook in place. They have their team in place. So they have an advantage over a new investor in a particular deal. But again, really making sure that it's a strong business and you have appropriate alignment when you're looking at them is important, and it's becoming an important part of the secondary market today.
And a follow-up question on that is, are there any key vertical sectors or geographies where you think that pricing in these secondaries is particularly attractive? And would that differ, the next part is from me, would that differ from any other vertical in your portfolio or any other access point in the portfolio?
You know, it doesn't really differ from other parts of our portfolio. Again, it's just like looking at our co-investments and today, because you aren't buying into an individual business, right? So it's a single concentrated bet on a company. So in today's market, we are tending to be in stable cash flow generating businesses, people who have real market share, can drive pricing, and tend to be in more defensive type sectors, given where we see the current market environment.
Fred, coming back to discounts to NAV, some listed private equity funds, for example, Pantheon in the UK, are trading at discounts of around 45%. Is this something that you would or could invest in? And is this telling us anything about a lag in unlisted valuations?
I'll try and take it kind of in reverse order. So we're unlikely to invest in that vehicle just because it's too diversified, meaning we rarely want to invest in either funds that we know, where we know the underlying exposures and get an informational edge by talking to the sponsors, or individual or handful of deals that we know and can do our diligence around, as opposed to kind of those aggregations where there's an ongoing and active management concept and what we're buying could change. And so, we're less likely to do that in that context. In terms of the valuation, I can't really speak to what exactly is going on in that vehicle. I can tell you there's always a suspicion in private equity that valuations lag, because they do, right? Like, obviously, if you go quarter on quarter, we talk about it all the time, how we're publishing things at quarter end and you're kind of rolling them through. I think you have seen most high quality sponsors take the multiples in their assets down already in line with the market and in line with kind of the expectations for what you're doing. And I really do think that's largely worked its way through. Like, you might have said at the end of Q1, for example, the market was only down 5% at that time. Then by the end of Q2, the market, at least in Q2 in the US, by June 30th, the market was down more than 20. So, in Q2, you had a substantial evolution, and then you had to have a kind of a catch up in the multiples and the market values of the private equity during that period. We've really seasoned through that at this point in time. And so, if people are still lagging more than kind of 3 months in terms of their valuations and their marks, that's probably particular to them. I think it really also depends on the sectors. So because we're not active in venture capital, I'd probably tell you, like, if you had to create a spectrum, on one end of the spectrum would be venture capital, where I could get a room full of 50 very reasonable people and not one of them would agree on what the value of the company was in venture capital. They all could be right, they all could be wrong. It's very much in the eye of the beholder. And then at the other end of the spectrum would be a high cash flowing, high quality, low growth private equity business with a good sponsoring, good management team that trades at 10 times EBITDA. And the debate would be whether to trade at 10.5 or 9.5. You're within a very tight band in terms of the reasonable debate around valuation and expectations. It's easier and it happens quicker to get those things to a full mark. So I don't know what's in that vehicle. I don't know the exact specifics, but the more something kind of teeters towards the hard to value, I think the more skepticism there's in this market, the bigger the discount will be, at least until kind of the proof is out there. I think the more it's diversified, kind of a core private equity building block like PE1, the easier it is to value. And I think it's part of the reason it trades like it does. Like, it also trades on market. And I think there's a reason it trades the way that it does, because I think it's been, kind of more reflective of what's going on. The thing I don't know is what will happen in the future, right? Which is like, and we'll see what next year brings and the year after brings. I think over time, we'll see positive and significant positive evolution in the underlying portfolio. I just don't know the exact timing of that. So, but it's hard for me to comment on the other vehicles, quite frankly, and why people trade things the way they do. There's probably particular reasons in that case, and I don't think we know them.
Great, thank you. Fred, maybe another one for you. Somebody's asked about your thoughts on the fundraising and general operating environment for the large cap listed GPs. So, what should I say? So the very large GPs, so we're talking about KKR, Apollo, Blackstone, those would be the names that people are talking about. And they're listed, meaning they themselves, the GP itself, as Adam is describing, it trades on the market, right? So you could go buy their stock if you wanted to. You'd be buying a stock in the asset manager, in those cases. They've obviously experienced very significant growth in assets over the last kind of 10 years. It's been a very favorable environment for kind of private equity fundraising, but particularly those scaled players in private equity. A lot of them do things beyond private equity. So if you looked at the underlying growth, you'd see that there's a lot of growth in credit and a lot of other alternative strategies that they offer, real estate in the case of Blackstone and some of the others. So, it's not just private equity growth, but it's kind of a broader growth. The fundraising environment was incredibly favorable for all sorts of GPs over the course of the last kind of 5 years, 10 years. It's less favorable going forward. It's actually harder for them to raise money on a go-forward basis than it's been in the past. I think there's a lot of reasons for that. The major one is that private equity has been growing as a share of institutional portfolios from sort of 0 to probably on average 15 or 20%. A lot of the larger institutions are there now. And so that secular force where they were catching up to the allocation that they thought was appropriate based on their portfolio modeling and their plan, they've gotten there. And so you'll have less of that force. I think the other is there'll be a little bit of a shakeout in performance during this period of time. So not all private equity is top quartile. Not all is the highest quality. And so
during an easy fundraising environment, there's a tendency for people to go into the second quartile, go into the third quartile, go into the fourth quartile, because that's where there's capacity available to them. And I think you'll see some of those allocations dry up. So again, can't really speak to specific houses. A lot of those firms are great firms with great performance, and they'll do fine, in terms of what's going on. But the industry as a whole, you're going to see it's harder to raise capital. In a weird way, that is fantastic for Grosvenor. It's fantastic for, Pengana and PE1 and the investors at PE1, because you want an environment where capital is scarce. And it's more difficult for sponsors to raise that capital, and it's easier to purchase investments at a better price. I mean, everyone always thinks in terms of, they look at the value in their portfolio and their statement on paper today, but for the most part, most people are continuing to invest every day of their lives, and being able to invest at lower valuations and higher forward expected returns where your money is more meaningful is a net beneficial thing for most people. And so I actually I'm excited about an environment where it's a little bit harder for people to raise money, and the capital we can provide is a little bit more meaningful to what they're trying to do.
That makes sense. We are still getting questions coming in thick and fast, but in the interest of time, I'm just going to ask two more, one for each of you, and then we'll respond to everybody else directly. Corey, first question for you. The presentation shows how funds launched after recessions are more likely to outperform. PE1 was launched in 2019, so before the recession. What does that mean in terms of our expectation for long-term returns?
A couple of things I'll say on that. One, obviously the funds we were investing in were deploying across vintages, and they will be deploying capital both in the pre-recession, if that's what we're in now, pre-downturn period, as well as through and out the other side. Back in before the GFC, valuations had gotten very broadly. Debt was very cheap, and so people were chasing a lot more deals. The part of the market that we play in, we use less debt. We are purchasing at lower entry multiples, down in the lower and in the mid market, so we're a bit more protected. And think that the deals that we were doing and the funds that we were investing in were very targeted. They were cycle tested folks, and while on the average, you will see on that slide that Fred showed earlier today, the returns from upper quartile were lower in sort of that pre-GFC period, you're still going to have the same outperformers from those cycle tested managers and the managers who've really been through it, and we believe certainly more so in the mid market where we play.
Great, thank you. Fred, last question for you. Interested in hearing more about Fulcrum Securities and the opportunities across the capital structure.
Sure. So with the base rate now being sort of closer to 4% than zero, and the spreads being probably 250 basis points to 400 basis points, it means the return in a first lien, meaning the absolute top of the capital structure safest debt security, is bordering on 8 or 9%, almost 10%. The second lien, which is typical in most of the capital structure, is double digits. It's over 10%, closer to kind of 11 or 12%. If there's a mezzanine piece of debt in the capital structure, that can be yielding today in the mid-teens. And then obviously equity returns are 20% plus today in terms of the overall securities. And basically everything went up and to the right in terms of return. But the further out you are in the risk spectrum, you also have an illiquidity premium that expanded, and you have a risk premium that expanded. So you kind of triple benefit in terms of forward rates of return. The Fulcrum security that I was mentioning, really this is all about when there is a company, a good one that we're interested in buying, and we found a good sponsor to partner with around that operation, you're going and purchasing debt, for 50 cents, 60 cents, 30 cents, whatever the discount is to par on that debt, with an expectation that security will turn out to be the one that cannot be paid out in full in a bankruptcy process. So, in my example, if there was a first lien and a second lien, and the first lien could get paid out in full, but the second lien cannot be satisfied in full, the second lien will end up with the keys. They'll end up with the company and control of the company. The first lien will be discharged in the bankruptcy and paid out. And you're often trying to purchase that debt at a material discount and create the enterprise at a reasonable enterprise value, through that process. And so the Fulcrum security really just means you're guessing which part of the capital structure, ends up with control of the company. If you're wrong, you can get wrong really two ways. One way is not as bad. So if you're wrong and my second lien gets discharged in full and I didn't end up with control of the company, but I bought a 50-cent piece of paper and I got paid 100 cents, 6 months later, 12 months later. It's really not the end of the world. If I'm wrong that I bought the mezzanine security and it turned out that the second lien couldn't be satisfied in full and the second lien ended up owning the company, I, as the mezzanine, might end up with little or no recovery on the security because I missed being in the fulcrum security. So it's actually pretty important that you're not kind of overshoot in terms of subordination in the capital structure when you're trying to take control. You want to make sure you're at or above that point. If you're going to take a risk, you take a risk that you get discharged early at a reasonable rate of return, as opposed to taking a risk that you're subordinate and therefore don't get paid a substantial amount of equity. There's often a holdout concept in bankruptcy where people want to push a plan through and get it approved quickly because there's value and cost being eroded in the bankruptcy process. But that holdout value is pretty de minimis. It's not normally worth, attempting to purchase those lower, more subordinate securities. So you really want to be in the fulcrum security or in one higher than that if you can at a substantial discount.
Great questions and great answers. We have gone over time, so I am going to end at this point. If a version of your question hasn't been answered, we will respond to you directly. So thanks to everybody who submitted those questions. I really did enjoy this conversation and I hope you did too. This is our final webinar in the series. So thanks to everybody who has dialed in. I've seen some of the same names over and over again, both as attendees and asking questions. So thank you. We really appreciate your interest and your ongoing support. And with that, thanks very much and enjoy your day.